to another episode of Equity Mates on AusBiz. We've reached the end of the week, but that doesn't mean we're not in for a bumper episode. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. I've enjoyed the last 3 episodes so much. I feel like I've learnt a lot. I've got some companies that I've added to my watch list.
Yep.
So I'm looking forward to closing out this week with Julia in a strong fashion.
As we always do. It's our absolute pleasure to welcome Julia Weng back to Equity Mates on AusBiz. Julia, welcome.
Thanks for having me back again.
So, Julia, we've covered a lot over the last week. We've spoken about, the large caps market here in Australia. We had a conversation on Tuesday about ESG, covered off some of your stocks on your watch list yesterday. So today we want to cover off reporting season. I know we said last week or a couple of weeks ago, Ren, that there's going to be no more reporting season.
Did we
content.
say that? I don't remember saying
that. It always provides. And then a bit of conversation about inflation, which is on everyone's radar at the moment. So let's start with reporting season. What were some of the sort of big trends or thematics that you saw come out of reporting season that were either interesting or surprising for you?
Yeah, to reflect back on reporting season, there are probably three things that stood out to us. One is inflation, and there's just there was the most mention of inflation through my career in terms of reporting season, and that's coming through a whole cross section of different industries, from your miners to your tech companies to industrials, and that's coming from your raw material costs. Your labor pressures. I think some of this is transitory. We've got closed borders, but I do think some part of it will be permanent. So, for example, let's freight. The cost to ship a container from Asia to US is still 5 times that of pre-COVID. And if you look at the forward books, ordering books for freight and for ships, they're at an all-time low. And you also had a lot of consolidation in the shipping sector prior to COVID. So there's not much capacity coming on. So, one of the things that, we take away is, margin assumptions. Are some of the margin assumptions unsustainably high? And so that's something that we reflect on a lot post this reporting season. The second one's actually the balance sheet, how strong the balance sheets are through this reporting period. And that's very different to COVID last year, where we saw, this a tidal wave of capital raisings. So there's banks are a good example, even through this lockdown 2.0, banks being able to return capital. And we're seeing, very minimal levels of distress through the market. We saw Telstra and Wesfarmers to buy back, the big miners, BHP and Rio, dividend yields are, into the teens. Oh, sorry, the free cash flows into the teens. So, very strong capital position that will bode well for continued wave of M&A as well. So, we still think the list companies are well placed to capitalize on potentially the less well capitalized unlisted players, and M&A will continue to dominate. But dividends and return of capital is another theme that we're cognizant of. And third is the acceleration in sustainability. And we talked about it early in the week. But yeah, there's a real gap opening up between your winners and losers, and that's driven by in recent periods of seeing China putting curb on steel emission, especially ahead of the Winter Olympic Games. And that's going to give you two camps. One, you've got accelerating demand, and it's a structural demand like aluminium and copper, nickel, and your battery materials. On the other hand, we're seeing oil and gas names having a higher cost of capital being factored in and continually being derated. So there's a definitely gap opening up, and there's uh, you know carrots and sticks in terms of regulatory response driving those outcomes. And I guess more broadly, we are expecting a transition from goods to services. In terms of your household and corporate balance sheet, there's over 300 bill of extra deposits. I mean, that's 14% of GDP. Some of it might stay. We're not expecting everyone to, clean out their bank balances. Some might be sitting in mortgage offset accounts. But we are expecting that transition from goods to services. Is that something that we're also watching? The trouble is, the the market's obviously onto that as well. So it's important to look for not just reopeners, but companies that can structurally benefit out of this lockdown.
So, Julia, I just want to pick up on the first of those 3 points around inflation, because that has definitely been a massive debate in the finance community, both in Australia but overseas as well. You mentioned that you think some of the inflationary pressures are here to stay, and you've been revising margin assumptions on the back of that. It'd be great if you could just expand on that and maybe talk about, are there any particular industries or sectors of the economy that you think are going to be hardest hit by the structural inflation, the inflation that's here to stay?
Yeah, look, that's going to really separate, the companies that have real pricing power from that don't. We're seeing a lot of mining services really hit hard by these wage pressures. So that to the extent that, commodity prices for some of those don't extend their run, that could spell some signs of distress. But I think it. But we have also seen great pricing power being enforced, partly due to that very strong demand as a result of very large levels of monetary and fiscal policy. So look, it's a hard one to a blanket rule saying which industries um, will be hardest hit. It really depends company to company.
And so, where do you sit on the debate between structural, long term, and I guess for a beginner, there's a lot of, those words are being thrown around a lot at the moment, and so people are trying to think about how to position a portfolio or build a portfolio. What's your advice to someone starting out trying to build a portfolio with a lot of this terminology being thrown around? Is it something to worry about, or how would you approach it?
Yeah, look, there's been a lot of debates in the market about this. Is inflation tempering? So things like used car prices, accommodation, um, or is it, or are we going to see a more persistent inflation that's been lacking for the last decade? Things like rent and labor. Um, the Fed being, this time being a lot more open about targeting employment rather than just a headline inflation level. I think, look, it's it's predicting inflation is not something that we sit about and worry a lot about. But I think the world has gotten very complacent in general about low inflation, which has persisted for the last 10 years. But I guess I would throw out, some important things to think about and food for thought. Things that weren't there the last 10 years. Firstly, we may have reached peak globalization and therefore the export of lower wages, and particularly this environment when onshoring and security of supply chain is so important, that could introduce wage pressures that wasn't there. And two, we've looked at this, unprecedented levels of monetary and fiscal support. And when you get these large shifts in demand, supply can be very difficult to catch up. And so that raising the possibility of inflation that could just persist for longer than people realize. And thirdly, decarbonization. We've talked about sustainability earlier, but sustainability it can only be brought out by a lot of investment. There's a lot of big numbers being thrown around. It could cost up to $150 trillion to decarbonize and make enable the world to get closer to net zero by 2050. And that leads to structurally higher inflation in some areas. We talked about a lot of the commodity things, and also things like fertilizers and ammonia through the likes of IPL, for instance. So that's something that we're watching as well, and that wasn't there previously. And let's face it, inflation is possibly the only way out of this extraordinary levels of government debt. I mean, you can raise taxes, but it's not very popular. So inflating our way out of our debt is potentially, the the only way out. So I guess we're watching for these changes in regime. We're not saying it will happen, but that's something that we are mindful of when we're looking at the portfolio.
Julia, you'll be pleased to know that Bryce has taken that inflation is coming, so lever up now and inflate your way out of it approach to his personal balance sheet. I guess the question becomes, if you think inflation is structural and I guess some of the elements of it are here to stay, how do you think central banks will respond? Do you think interest rates are going to go up? And how much does central bank monetary policy, how much of an effect does that have on your investment decisions?
Yeah, look, the central bank will be careful to avoid, what you could call a taper tantrum a few years ago. And so I think it is very deliberate in its communication, in its messaging this time, and will likely let the economy run hot, before it, significantly tapers and increases interest rate, which, we're not suggesting will happen anytime soon. So, inflation's all about expectations as well. So once you have expectation of, high wages, you ask for high wages and it kind of feed on itself. So, I think we're likely to see a sustained period of high inflation, but there will be a lagged central bank response. Um, and the housing market globally is run incredibly strong. So you need household balance sheets to be able to do strong enough to be able to take an increase in interest rates. So how we think about it, we're looking for stocks with genuine earnings growth. So as interest rates potentially increase over the next 3 to 5 years, you may see a derating of the overall market. So you really need valuation support. So be careful about chasing some of the growth stock names, like some of the tech companies, which are loss making. And when we sit down, look at how do how does it justify its share price? Well, like 90% of values come from um, potential earnings that are 10 years out. And so, increase in your discount rate, has a dramatic evaluation. So, I guess you got to be careful of that. Um, but yeah, so, we're mindful of which companies really have pricing power. And that's, yeah, something that we're doing a lot of work on.
And so, Julia, to close out the conversation for today and for the week, and looking forward to the end of this year and into next, is there anything that you think the market consensus is sort of getting wrong about either inflation or any other thematics that you discussed looking into next year?
Yeah, I guess closing off what we spoke about, I think the market is still suggesting that bond yields are low forever and interest rates are low forever. And that's still pricing it that way. So we're just, mindful of this tail risk that it may not. So I think, looking at a lot of the tech names, they're still extremely expensive. And on sales or on earnings. So yeah, we're very mindful of the very lofty valuation multiples in those sectors. And yeah, so uh, equally, we're looking at some of the, I guess, more reflationary exposures, like your financials. Within that bucket, CPU, computer share, has extremely high leverage to earning to interest rate rises. 50% of its earnings um, come from have interest rate exposure. So that's something to watch. if you're thinking of, in terms of thinking about interest rate exposures.
Well, Julia, that brings us to the end of our episode today. Unfortunately, we have run out of time, but a massive thank you for joining us all week this week, chatting about all things large cap. We spoke about ESG, and on yesterday we had your watchlist Wednesday. So for anyone who's just tuned in today, make sure you go and catch up on demand to all of those videos that we had Julia on for. It's been a great week. Thank you for your time. As always, we very much appreciate it.
I enjoyed it very much as well. Thank you.
And that brings us to the end of another week here at AusBiz. It was great having Julia on for the week, Ren, and we're going to be back, as always, next week.
As always, can't wait to see everyone. Hope you all have a good weekend, and thanks for watching.